Hello, everybody. So today I want to talk about UiPath, a new stock on the channel. This is a stock that I actually used to own, and that's been on my radar. I don't own it anymore, but it's been on my radar, and it's got my attention today because the stock is up 27%. Everybody's talking about it, and so I decided to look under the hood and see what was happening. Are we seeing something with the growth of UiPath? Did the growth maybe exceed my 30% threshold? So quickly, if you're new to UiPath, what does UiPath does? UiPath is what we call robotic process automation. So it allows you to automate a whole bunch of activities that would usually be done by, I don't know, the office assistant, like, for example, drag and drop tasks, or copy and paste tasks, or data collection tasks, like all sorts of tedious tasks that you would do with a mouse and a cursor and that you have to do like all day long. Like, for example, drag and drop files, moving PDF from one database to a desktop or something like that. That is done typically with low-skilled employees. All of these tasks you can automate with robot process automation. So that's why, if you actually understand the little the little logo that they have here, it's like a mini, a mini human or a mini cursor working for you in your computer, just copying and pasting and moving things and automating tasks that used to be done by humans. This fits into a theme of businesses being more and more software driven and less data driven. You have less and less people sitting at the office in front of your desk doing tiny coordination tasks. These coordination tasks are being done by software, and this is an example of the leading software in that space. Now that we know the business model, now that we know that what they do, we need to know a few more things. First of all, they're a recurring revenue company, right? They're your typical SaaS company, annual recurring revenue. And the reason why I'd gotten out of this stock is because the growth had become flattish in 2023 and late 2022, because obviously, rates were up, world was going to end, and because of that, companies delayed their investments. But it looks like they're investing again, as you will see, because, so they've had 35% CAGR on revenue growth over the longer run, which is nice. But actually, if you look at the past few years, they have not had that. You can see January 2023 to April 23 to July 2023, they were down. They were actually slightly down, which was one of the reasons why, when you look too closely at the stock, I was not interested. Question for this video: is this stock, UiPath, is it an inflection point? Are we witnessing an inflection point? So this was last quarter. This was this quarter. So this quarter, they posted 326 million in revenue. And this is what they're guiding for the next quarter. So the next quarter, Q4, they're guiding 384 million. So moving from 325 to 384 million, I don't need to use the calculator to know that that's a lot of growth. Going from 320 to 380 is a lot of growth. So when you calculate it, Q4 to Q3, so quarter over quarter, Q3, Q4 growth is 17.79%. That's their prediction for a single quarter. And we can see that this has accelerated, because in Q2, they had already shown that inflection point, and I'm surprised I didn't catch it. I should have caught it. I should have covered this. I don't have enough time to monitor all of these stocks. I should have caught this, because already between Q3 and Q2, we had seen early signs of the growth rebounding for that stock, because they had posted 13% quarter over quarter growth between Q2 and Q3. So we had 13% last quarter, and they're guiding for 17% this quarter. So the growth, pardon my English here, but I'm going to say the growth is spiking. We're seeing an inflection point in that growth rate. This has me wonder, what if for Q1 24, they start guiding, 20 or 25% growth? Could we have revenue growth a la NVIDIA for this company? Possible. I find this very surprising that this company went from flat to down, to all of a sudden a annualized growth rate of 89%. Because Here's the thing. If you take 17% and you 17.79 and you annualize it, right? You take the instant quarterly rate and you annualize it, you're at 89%, right? So that's a tremendous yearly growth rate when you translate 17 into a yearly growth rate. So I'm going to try to be bold and use a reasonable growth rate and an optimistic growth rate, which is the current run rate guided annualized. But I just want to say that this is where I need to be careful on this channel. And I think as investors, we all need to be careful using analysts' estimates. Analysts are sleeping. When I look at Seeking Alpha, when I look at the prediction for analysts forward next 12-month growth, revenue growth for the next 12 months, the analysts are predicting 19%. So they're predicting 19% revenue growth, these analysts, while the company itself just guided almost 18% for next quarter alone. So that means that the analysts' target of revenue growth is entirely false. And of course, in my spreadsheet, getting that number right is the most important thing, because in the way I value stocks, if you're new to the channel, the way I value stocks is with the enterprise value over gross profit over revenue growth metric. It is my spin on the PEG ratio, but not using earnings, because I don't want to use earnings, because SaaS companies and tech stocks in the 21st century, everything below the gross profit line is, in my view, often an investment. I'm part of a generation who looks at marketing as an investment. I look at R&D as a reinvestment in the business. And so I look at this as a good thing. That's why I don't take the bottom line. I take the gross profit line. That's what matters to me. I want to see the businesses reinvest. And I want to see those businesses not be in a hurry to pay taxes. I believe that's how business is mostly done in the 21st century, and that's why these companies outperform. So if I take their gross margin, which is outstanding, by the way, 87%. That's outstanding gross margin. And I take the revenue growth of 89%, which is what I just calculated. I'm calling this optimistic. And then 50%, which, I took that randomly, but I call this reasonable. I get to a 0.23 or 0.13 in my spreadsheet. And on average, I get a 0.18. So this stock, with that new renewed level of growth, has become very, very, very cheap. Not Stone Cold cheap yet, right? Not HIMSS cheap, but dirt cheap. And of course, what if it does? That's the question. What if next quarter they do indeed do 18%? And what if the quarter after they start doing some, say, I don't know, what if they do 25%? Well, then you get into an even cheaper. Even cheaper stock. And by the way, these numbers are with the enterprise value as of right now. So after the 27% rise in market cap, that's using that updated enterprise value. Actually, if you had used the enterprise value of yesterday, but you wouldn't have known those numbers. But if you had done that, you would have gotten an even better valuation. So I like this stock very much. I am following it pretty closely, and I might get in. Thank you so much for watching. This was not investment advice. This is just entertainment. I appreciate your likes. I appreciate your subscriptions to my channel. I appreciate you following me on X. Thanks for watching, and have a wonderful day.